Welcome to The Explainer. Today, we're diving into a fascinating, seriously high-stakes battleground in their business world, and that is commercial law. We are going to unpack the dramatic tension between the incredible legal protections of a corporation, the ultimate shield, and the fierce exceptions that can literally tear those protections completely away. So, if you've ever wondered how business owners protect their personal assets, or on the flip side, how courts catch bad actors trying to hide behind a company name, you are absolutely in the right place. Let's get into it. Now, you might be thinking commercial law is going to be incredibly dry and boring. But listen to this quote from the foreword of our source material, the 2026 Reviewer in Commercial Law by Judge Rasil S. Aquino Tambasakan. She literally drops a Dragon Ball Z reference, talking about not being Tien Shinhan who do multiply and needing to go Super Saiyan to avoid getting lazy with the reading. Yes, a legitimate legal author using anime to keep her readers awake. And honestly, that perfectly captures our approach today. Because while the stakes of corporate law are massive, we're talking millions of dollars and serious personal liabilities, exploring it doesn't have to be a snooze fest. Here's our quick roadmap for today's explainer. First, we'll meet the artificial being. Second, we're examining the separate personality shield. Third, we'll look at the dramatic piercing of the corporate veil. Fourth, the alter ego theory. And finally, we'll break down the strict three-pronged test courts use to decide these massive cases. Section 1. Meet the artificial being. What exactly is a corporation? So right off the bat, the revised Corporation Code defines a corporation as an artificial being created by operation of law, having the right of succession and the powers, attributes, and properties expressly authorized by law. The absolute core of this is that phrase right at the beginning, artificial being. The law is literally breathing life into a piece of paper, creating a brand new invisible entity that can enter into contracts, buy property, and be sued. And it does all of this entirely separate from the actual human beings running it. It's wild when you think about it. Let's break that down into 4 core attributes. First, it's an artificial being. Second, it's created by operation of law, meaning you can't just stand up and declare, I am a corporation. You need the state's consent. Third, it has the right of succession, which basically gives it legal immortality. If the founders pass away, the corporation just keeps on living. And fourth, it only has expressly authorized powers. It can't just go rogue and do whatever it wants. It can only do what the law and its charter specifically say it can do. Moving right along to Section 2, the separate personality shield, protecting the owners. Okay, so to really understand just how impenetrable this shield is, let's look at a real high-stakes scenario from the 2013 commercial law bar exam. Imagine this. The tax authority slaps ABC Corporation with a massive tax deficiency of 26.7 million pesos. Can the government just bypass the company and go straight after the personal bank accounts of the directors and stockholders to get that money? The answer? An emphatic, absolute no. Under the doctrine of separate juridical personality, that shield holds firm. This is where the principle of limited liability really shines. The corporate debt is absolutely not the debt of the stockholder. Look, if the corporation runs out of money, the owners might lose their initial investment in the company, sure, but their personal homes, their cars, their savings, those are fully protected. The actual text from the legal reviewer highlights just how absolute this separation is. It points out that stockholders merely possess an inchoate or incomplete interest in the corporate assets. In simple terms, you might own shares in the corporation, but you don't actually own the corporation's property. You have a right to a share of the profits, absolutely, but you can't just intervene directly in litigation involving corporate property. Why? Because you and the corporation are 2 entirely different entities in the eyes of the law. And get this, because it's treated like a person, the artificial being even gets its own constitutional rights. It has the right to due process, for sure. But look at what it does not have. It doesn't have the right against self-incrimination, and it can't claim moral damages. Why? Well, because an artificial being doesn't have a nervous system. It can't experience fright or anxiety or wounded feelings. A corporation simply cannot get its feelings hurt, so there's no way it can be awarded moral damages for emotional distress. Which brings us perfectly to Section 3, piercing the corporate veil, the vulnerability. Now, the law isn't naive. It is not going to let this corporate fiction be used as a convenient cloak for illegal behavior. When bad actors try to hide behind the shield, the courts will whip out the doctrine of piercing the veil of corporate fiction to tear that shield down and hold the humans personally liable. Courts will step in during three specific severe scenarios: when the corporate fiction is used to defeat public convenience, in fraud cases where it's used to justify a wrong or defend a crime, and in alter ego cases.
Let's really zoom in on that last one for Section 4, the alter ego theory, exposing the puppeteer.
The Miracle Mining Corp case is a brilliantly perfect example of this alter ego concept in action. In this scenario, the courts had to look closely at a parent company and its subsidiary and ask, are these truly separate entities? Or is this entire setup just a total sham to evade paying monetary obligations to dismissed workers? The alter ego theory basically asks a simple question. Is this corporation a legitimate independent business, or is it just a puppet whose strings are being completely pulled by another person or company just to dodge liabilities? So how do courts actually expose the puppeteer? They use a rigorous, strict method. That's Section 5, the three-pronged test: control, fraud, and harm. I want to be super clear here. Piercing the corporate veil is severely frowned upon by courts. It is very much the exception, not the rule, and it demands clear, convincing evidence. To successfully pierce the veil under the alter ego theory, you have to sequentially pass all three of these incredibly strict legal hurdles: the control test, the fraud test, and the harm test. Let's break them down real quick. Step 1 is the control test, sometimes called the instrumentality test. And we're not just talking about owning the majority of the stock here. We are talking about complete, absolute domination. The parent entity must dictate the finances, the policies, and the business practices so heavily that the subsidiary literally had no separate mind, no separate will, or existence of its own at the time of the transaction. It's essentially an empty shell, acting purely on the master's command. Okay, so if you prove control, you move to prong 2, the fraud test. Because just having control isn't actually illegal by itself. You must prove that this control was specifically used to commit a fraud or a wrong. Courts will look at the totality of circumstances, hunting for massive red flags. We're talking about commingling personal and business funds, which, by the way, is a super common mistake small business owners make. Other red flags: having identical directors and officers, a total absence of actual corporate assets, or intentionally concealing true ownership. Basically, if you treat the company bank account like your own personal wallet, you are practically handing the court a reason to destroy your shield. Finally, we hit prong 3, harm or the causal connection. Even if you prove control, and even if you prove fraudulent behavior, it still isn't enough on its own. The plaintiff must prove that this specific fraudulent control proximately caused their exact financial injury or unjust loss. There has to be a direct, clear line between the puppeteer's bad behavior and the plaintiff's empty pockets. But if all three prongs are met, boom. The veil is pierced, the shield shatters completely, and personal liability falls squarely on the owners. So what's the big takeaway from all of this? The corporate shield is incredibly powerful, no doubt, but it requires actual maintenance and respect. You have to treat the artificial being as exactly that, a totally separate entity. I'll leave you with this provocative thought to chew on. Look at your own ventures or the businesses around you. Do they strictly respect the corporate veil through proper record-keeping and totally separate finances? Or are there daily practices, like casually mixing funds and ignoring legal formalities, secretly turning their protective shield into a sword that will one day be used against them? Definitely something to think about. Thanks for joining me on this explainer, and keep learning.